Lex Greensill has been banned from being a company director for 9 years. The official order, effective June 23, 2026, is the government's final word on his role in the collapse of his financial empire. But for the investors who lost everything, it's just a date on a calendar. For the employees whose jobs vanished in March 2021, it's a footnote to a catastrophe. More than £1.6 billion in liabilities surfaced when Greensill Capital imploded. A failure so complete that regulators pointed to serious misconduct by the founder himself. The official disgrace was documented, but the damage is still being calculated across the globe. To understand how the man at the top ended up here, you first have to understand the simple, powerful promise he sold to the world. A promise to fix a broken part of the global economy. A promise that became its own kind of poison. That promise was called supply chain finance. The concept was elegant and addressed a genuine flaw in global commerce. Small suppliers for large corporations were often forced to wait months for payment, crushing their cash flow. Greensill Capital proposed a solution. It would pay the supplier's invoice immediately for a small fee. The large corporate buyer would then repay Greensill later. It was a simple arbitrage on trust, turning a large company's strong credit rating into immediate cash for its smallest partners. The model was not just clever, it was seen as virtuous, oiling the gears of the real economy. This powerful narrative attracted a circle of elite backers. Former UK Prime Minister David Cameron joined as a senior advisor, lending immense political credibility. More importantly, Softbank's Vision Fund provided a colossal injection of capital, signaling to the market that this was a vetted, high-growth technology platform. With validation from the highest levels of politics and finance, Greensill's ascent seemed guaranteed. The firm was positioned not as a bank, but as a fintech disruptor poised for explosive growth. But beneath the surface, the entire structure rested on a single fragile pillar: trade credit insurance. Every early payment Greensill made was insured. If a corporate buyer defaulted, an insurer was supposed to cover the loss. This wasn't a diversified risk model, it was a chain of dependency, where one broken link could shatter everything. The world saw a financial technology innovator. The reality was a machine wholly dependent on third-party guarantees. The mathematics seemed unstoppable. But a balance sheet built entirely on promises that someone else would pay is only as strong as the paperwork that enforces it. And soon, that paperwork began to burn. By its apex, the machine was running at full power. A multi-billion-dollar valuation cemented Greensill's status as a titan. This was not just paper wealth. It was fueled by billions flowing through funds managed by Credit Suisse, all chasing what they believed was a diversified portfolio of low-risk corporate debt. Greensill was global, its name synonymous with a smarter way to finance supply chains. The momentum felt irreversible. A financial ice shelf, solid and imposing, stretching to the horizon. But the engine of that growth was a hidden fragility. The supply chain finance notes were sold as near risk-free. The reason? A complex, layered chain of trade credit insurance. Diversification was the promise. The reality was breathtaking concentration. Those billions in investor funds, and the assets underlying them, rested on that insurance holding. Up to $10 billion in Greensill-linked assets. Asterisk sat frozen in Credit Suisse funds alone. A house of cards, where every card leaned on the same, single insurer. The market was oblivious. This entire edifice was balanced on a single point of failure: policy renewal. And in mid-2020, the underwriters who guaranteed those billions looked at the risk profile and made a quiet decision. They would not renew. To the outside world, nothing had changed. But inside Greensill's London headquarters, the countdown had begun. The pillar was scheduled for removal, and no one outside the walls knew the clock was already ticking. The final act wasn't a market shock. It was a series of internal decisions. In late 2020, Lex Greensill caused his companies to enter into transactions with Katerra that removed legal protections from a Credit Suisse fund's investment. Legal proceedings would later establish these transactions had the purpose of releasing Greensill's only asset and prejudicing creditors. The safety mechanisms sold to clients were being dismantled from the inside by the very hand that built them. The purpose was not to fortify the business. It was to move money in ways that directly undermined the insurance structure. Then came November 2020. Greensill Capital received a payment of $440 million. Under its agreements with the Credit Suisse funds, that money was designated to redeem notes owed to investors. Instead, Lex Greensill caused or allowed those funds to be used for other purposes. Gone. Redirected. Vanishing into the machinery of a company already running on borrowed time. This, combined with the removal of legal protections, led to the notes defaulting in March 2021, crystallizing a $440 million loss for the fund. Not a miscalculation, not a market downturn, a direct breach of duty. For this, and other related conduct, Lex Greensill would eventually agree to a 9-year disqualification as a company director, a ban length that speaks louder than any courtroom verdict. The March 2021 collapse was therefore not an implosion of assets. It was an implosion of accountability, and it ignited a legal firestorm spanning continents, with financial claims so vast they would test the foundations of the insurance industry itself. The March 2021 collapse was not an ending. It was a detonation, and the shrapnel was still flying. Australia became the central battlefield, where 11 interconnected federal court actions attempted to unspool the damage. Insurer IAG found itself defending claims with a face value of around $4 billion from Greensill Bank alone. The very insurance policies designed to make the model bulletproof were now the bullets heading straight for it. The legal machinery ground forward, consuming years and resources in pursuit of financial restitution. The litigation cascaded. Credit Suisse and White Oak launched separate claims, piling another $3 billion onto the wreckage. For investors, the pain was formalized in a class action citing $2.3 billion in problematic loans. Some confidential settlements were reached, but these were not resolutions. They were partial retreats, white flags planted on a battlefield too large to surrender. The conflict would stretch on for years. The ultimate accountability for the man at center came not in handcuffs, but a regulatory epilogue. Lex Greensill agreed to a 9-year disqualification as a company director, a ban so far above the average it functions less as punishment, more as a verdict. He sidestepped a 6-week trial. His camp denied dishonesty, but the facts spoke plainly. The Katerra transactions that gutted protections for a Credit Suisse fund, the $440 million diverted instead of redeemed. Duties breached, safeguards hollowed out, by the one person who understood them best. But years of litigation cannot rewrite the boardroom choices of November 2020. And that leaves a single, unnerving question hanging over every dollar lost, every courtroom filing, every settlement signed. What systemic blind spot allowed one person to dismantle the safeguards on billions, and no one noticed until the fund doors were already locked? Searching for a villain misses the point. This wasn't a complex product failure. It was a catastrophic verification gap. A structural blind spot where a simple promise could be broken in silence. The investors saw paperwork. They saw insurance. They saw a name. They trusted the paperwork. They never built a system to independently verify the safety net was still there. The blind spot had 3 pillars. First, total reliance on a single point of risk transfer, trade credit insurance. One keystone holding the arch. Second, the consolidation of control in one man. Lex Greensill. He could, and did, alter the protections. The proof is in the transactions with U.S. construction group Katerra, deals that gutted safeguards for a Credit Suisse fund, and the resulting $440 million default. The protections had been stripped away. Third, and most dangerous, the time lag. The foundation was demolished months before anyone saw the cracks in the walls. The protection was a ghost, and the market was still pricing it as if it were solid. So the lesson isn't about exotic finance, it's about governance. It's about designing systems where the person selling the safety net cannot also be the only one with the switch to turn it off. If risk is transferred, the transfer must be visible, real-time, tamper-proof. A live signal, not a periodic report. The collapse wasn't just a financial event. It was a failure of transparency infrastructure. The status of the net cannot be a secret held by the trapeze artist. If the insurance was the foundation, and one signature could pull it out from under $1 billion fund, Then who was truly watching the controls from the other side of the table?